Okay, so Wall Street just dropped one of the most confusing earnings reports we've seen all year. CoreWeave, which is, the big AI infrastructure darling, posted what looked like an absolutely historic quarter, and yet the stock got completely hammered. So let's dive in and really unpack this massive disconnect between CoreWeave's insane growth story and the market's frankly brutal reaction. I mean, just look at these numbers. On the surface, they're nothing short of spectacular. Q4 revenue hit $1.57 billion. That's a 110% jump year over year. And their guaranteed revenue backlog, a staggering $66.8 billion. Now, these are the kinds of numbers that should send a stock to the moon. But that is not what happened. Nope. Instead, the stock cratered over 11% in after-hours trading. So you have to ask, right? What caused this massive sell-off? What did the trading algorithms and the big institutional investors see buried deep in that report that just completely overshadowed that incredible top-line growth? Well, that's the puzzle we're going to solve right now. And the answer, really, it all starts with a cash burn shockwave that was hidden away in the income statement, and maybe more importantly, in the company's guidance for the future. Okay, so here's the first clue. It's all about the contrast. While that revenue more than doubled, CoreWeave's net loss didn't just grow, it absolutely exploded. It went from a $51 million loss a year ago to a massive $452 million loss in this quarter alone. For the market, that was red flag number one, a big one. Then, the second hit came from their outlook. See, Wall Street analysts had built these models expecting over $2.2 billion in revenue for the next quarter. But CoreWeave's own guidance, it came in way lighter, forecasting $2 billion at the high end. And look, for a hypergrowth stock like this, guiding below what the street expects, that's a cardinal sin. And then they dropped the hammer. Management revealed that they're planning to spend a jaw-dropping $35 billion on capital expenditures. We're talking data centers, chips, the whole shebang in 2026. Just 2026 alone. To give you some perspective, that is more than double what they spent in all of 2025. This single number sent an absolute shockwave through the financial world. Because you see, that $35 billion figure, it's not just a number on a page. It represents a monumental financial bet that comes packed with an incredible amount of risk. Building the actual physical infrastructure for the AI revolution at this kind of speed is just brutally expensive. And you can see the impact right here. The company's adjusted operating income margin, which is a really key measure of profitability, it just collapsed. It went from a pretty healthy 16% all the way down to just 6% in a single quarter. The cost of this growth is absolutely crushing their short-term profits. So how do you pay for a $35 billion expansion? Well, you take on debt, a lot of it. In just the last 3 months, CoreWeave paid $388 million just in interest on their loans. That's up 160% from the year before. The cost of borrowing that money is skyrocketing. And this right here, this really gets to the heart of what the market is afraid of. Investors are now aggressively pricing in all this risk. They're seeing this massive debt load, huge execution risk. I mean, what happens if data center construction gets delayed? And of course, those mounting interest payments that could just eat the company alive if their revenue plans hit even the smallest speed bump. But this isn't just some story of reckless spending and debt. No, there is a very clear, long-term strategy behind this high-risk maneuver. It's all about building the indispensable power grid for the future of artificial intelligence. What we're really watching here is a classic scale over profits play. It kind of reminds you of Amazon back in its early days, right? CoreWeave is deliberately trading away any short-term profitability and taking on all this debt to build what they hope will be an impenetrable economic moat. They want to become the essential utility, like the power company, for the entire AI industry. And this visualizes the whole bet right here. On one side, you've got that terrifying $35 billion cost. But on the other, you've got that $66.8 billion in guaranteed, signed multi-year contracts. The strategy is to spend like crazy now to service the massive locked-in demand that they already have on the books. And the physical scale of this whole thing is it's immense. They've already contracted for over 3.1 gigawatts of power. To put that in perspective, that's enough juice to power millions of homes. And all of it is being dedicated to running the next generation of AI models. And hey, if you're looking for a vote of confidence, you don't have to look very far. NVIDIA, the company that actually makes the chips at the heart of this whole AI revolution, they just invested another $2 billion directly into CoreWeave. They are betting big that CoreWeave is the platform that's going to best utilize their technology at a massive scale. So, this brings us to the final verdict. When you look at all the data, there are really two starkly different ways an investor can interpret CoreWeave's future from here. The bear case is pretty simple. The debt load and the capital spending are just way too big. It's a massive red flag, especially in this economic environment. But the bull case is just as compelling. If CoreWeave can actually pull this off, then the market is severely mispricing the long-term value of this infrastructure moat they're building. This sell-off could be a generational buying opportunity. And that really leaves us with the final question. Is CoreWeave pulling off a brilliant Amazon-style land grab for the digital territory of the AI future? Or is that $35 billion price tag just too high, too risky, and way too dangerous for any investor to touch right now? That is the multi-billion-dollar bet that all of Wall Street is trying to figure out.